Alternative investment limited partnerships have never been more popular. I think investors should think twice before committing funds to alternative investment limited partnerships, especially if the investment is being sold by a broker, aka financial advisor. There are many reasons to avoid alternative investment limited partnerships. Here are 7 of the most common: the low volatility myth, huge fees, no transparency, tax complexity, no performance reporting, no liquidity, and debt. Let's start with the low volatility myth. Many distributors of alternative investment LPs, whether it is real estate, growth equity, private credit, VC, or buyouts, will focus on the supposedly low volatility of alternative investments. But this low volatility is a myth. The volatility is there, you just do not see it. Alternative investment LPs do not mark to market on a daily basis. Instead, the general partners typically perform quarterly valuations, which are sent to limited partner investors. These valuations should be taken with a grain of salt. Unlike the stock market, where real-time valuations are available whenever the stock market is open, alternative investment valuations can be highly subjective. Methods for valuation, such as the price from a new round of financing, transaction multiples, or comparable multiples from publicly traded companies, are just guesses and not a reliable indicator of investment value. Because valuation is generally done just a handful of times per year based on subjective methods, volatility appears to be low. In reality, the underlying fund investments are moving up and down much more than limited partners realize. Huge fees. Most investors know, or should know, that alternative investment LPs have substantial fees. General partners will receive a management fee, which is often 2% of the fund assets, and a carried interest fee, which is generally 20% of fund profits. But in addition to the management and carried interest fees, many alternative funds, especially real estate funds, have other ways to enrich themselves. If you carefully read the private placement memorandum, PPM, for your limited partnership investment, you may find that the general partners of your fund are getting paid on things like debt placement, acquisition and disposition fees, refinancing fees, construction and property management fees, on and on. Often, these fees are a form of double dipping, where the fund is charging investors a fund level fee and an additional property level fee for the same service. Unfortunately, too many investors do not read the fine print and challenge the general partners on these exorbitant fees. They just pay the fees and they never know. If you buy your alternative investment limited partnership from a financial advisor, they need to get paid too. So be aware that alternative investments sold by brokers usually carry significant under-the-table commissions paid to the broker. No transparency. Unlike a fiduciary, a lawyer, or an accountant who will show you their fees, all the fees in your limited partnership alternative investment will be hidden from you. Do not expect any transparency here. Tax complexity. Alternative investment limited partnerships distribute a Schedule K1 instead of Form 1099. The Schedule K1 is necessary for you to report your share of partnership gains and losses, deductions, and credits to the IRS. Because partnerships must finish their own tax return before they can issue K1s to investors, the investors often receive their K1s very close to the April 15th tax deadline. Many limited partnerships are so complex that more time is needed to prepare their tax return, and as a result, the partnership will file for an extension. Due to the extension, limited partners will receive their K1 after the April 15th filing deadline and will not be able to comply with the April 15th tax filing deadline. The more limited partnerships you invest in, the more significant this problem becomes. When you receive your Form K1, your tax return automatically becomes more complicated and requires more time and attention from your accountant. If you invest in many alternative investments and receive a dozen or so K1s, your tax return could easily cost $5,000 or higher just to prepare. No performance reporting. In 25 years of working in wealth management, I have yet to see a performance report from an alternative investment. I'm talking about a time-weighted net of fees return calculation comparing the performance of the partnership to a benchmark like the S&P 500, Dow Jones Industrial Average, or Bloomberg Aggregate Bond Index. In my experience, most general partners will get their limited partners excited about a return of capital multiple or hype up their IRR. But what I've discovered is that nearly always, if the investor had simply put their money in the S&P 500, they would come out ahead and with less tax issues. Warren Buffett is known for stating that private investments can rarely beat the S&P 500, and he is right. No liquidity. Once you invest in an alternative investment limited partnership, you may not be able to access your funds for many years. Under stressful market conditions, such as a recession, alternative investment general partners often gate their funds, eliminating any liquidity options. Before you commit capital to an alternative investment, be sure you understand the liquidity options. If the fund manager tells you they expect to return capital in 3 to 5 years, those projections are usually best case scenarios. Add a few more years to that timeline to account for unforeseen economic events. Debt. Alternative investments often use debt to enhance returns. Debt can help you get there faster, but it can also wipe you out. Just look at what is happening in every downtown area in America right now. Beautiful office towers are selling for pennies on the dollar everywhere these days. The debt against the buildings is the number one problem for the investors who are losing everything. If these investors had bought the buildings for cash, they would have no problems. Instead, in a period where vacancy rates have moved up and cash flow is down, many cannot service their debt and they are defaulting on their loans. When you invest in an alternative investment LP, make sure you understand how the general partners plan to use debt. If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content and you want to see more of it, just search for Highpass Asset Management. I hope this video was helpful, gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.